Welcome to Talk Tickers, your direct line into earnings season. Today, we're cutting through the noise on Alibaba Group's latest quarter, the June quarter 2025.
Yeah, there's a lot to unpack here. We'll dig into the numbers, the strategic moves, and what it all really means.
Exactly, because that initial market reaction was, well, interesting is one word for it, a bit all over the place. We need to figure out why.
Definitely. So let's get straight to those headline numbers for the June quarter.
Okay, so non-GAAP diluted EPS age came in at RMB 15.06, that's $2.15, and that actually beat the Refinitiv consensus by 1.2%, so a beat there.
Right, sounds good on the surface. But the top line?
The top line total revenue was RMB 236.5 billion, or about $33.7 billion. Now, that's up 5% year over year, which isn't bad,
Yep.
But it did miss the consensus estimate by 1.5%. So EPS beat, revenue miss, classic mixed signal.
And the profitability picture was even more complicated, wasn't it?
Very much so. GAAP net income looked fantastic, up 63% year over year.
Wow, 63%. But what's behind that number?
Mostly mark-to-market changes on investments and a gain from selling something off. So, not really core operations driving that huge jump.
Ah, okay. So the accounting stuff. What about the operational profit metrics, like non-GAAP net income or adjusted EBITDA?
That's where it gets tricky. Non-GAAP net income actually declined 9% year over year, and adjusted EBITDA was down 4%.
Okay, so the underlying operational profitability took a hit. That makes more sense given the revenue miss and maybe some spending.
Exactly. They did return capital, though, $4.1 billion in share buybacks, reduced the share count by about 2.1% in the quarter.
Which is usually something investors like to see. So how did the market actually react to all this? You said it was interesting.
Yeah, it was fascinating. There was this initial excitement in pre-market trading. Shares jumped up.
Right. Probably saw that EPS beat and cloud numbers we'll get into.
Probably. But then, once the market actually opened, things cooled off fast. The stock settled into a slight decline.
So cautiously constructive is a good way to put it. Investors are weighing that EPS beat and the cloud momentum, which looks good.
Against that revenue miss, and crucially, this ongoing story about heavy investment.
Yeah, it's a classic balancing act, isn't it? Growth versus the cost of that growth right now.
Yeah, okay, so let's unpack that further. Management talks about navigating two historic opportunities. Big words.
Very big words. Sounds like they're framing some major strategic shifts.
One is this aggressive push into AI and cloud. The other is completely reimagining their consumption platform, their e-commerce side.
Right. Two massive undertakings.
Let's start with AI and cloud. The Cloud Intelligence Group. That seems like a real bright spot, doesn't it?
It really does. I mean, AI-related product revenue showing triple-digit growth.
For the 8th consecutive quarter, that's pretty incredible.
It is. And management emphasized this pivot towards higher-margin public cloud services. They're trying to move away from those lower-margin project-based deals.
Which makes sense long-term. You want recurring, profitable revenue.
Exactly. It shows the market maturing, right? It's not just about grabbing volume anymore. It's about building a sustainable, profitable cloud business like we saw with AWS and others eventually.
And the scale of investment here is just huge.
It's massive. They've committed RMB 380 billion over the next 3 years for cloud and AI infrastructure.
380 billion RMB. Wow.
And they've already spent over 100 billion RMB in just the last year. So they're putting serious money where their mouth is.
But it's not just spending, is it? They're innovating, too. They've got these new Qwen 3 models, which are apparently top performers globally.
Yeah, and they're even open sourcing some stuff, like Qwen 2.2 for video generation and Qwen image.
Which raises that key question. How do you actually make money from all this innovation, especially the open source parts?
Well, that partnership with SAP seems like a big piece of the puzzle. Alibaba Cloud becoming SAP's global partner, running core systems, using Qwen for AI services. That's serious enterprise validation.
Okay, so enterprise adoption is one path.
Definitely. And then you see the internal stuff like AMAP 2025, this AI native map app, or DingTalk using AI agents. They're basically building their own demand and showcasing the potential across their whole ecosystem.
Right, integrating it deeply. Okay, let's shift to the other historic opportunity, the consumption platform.
Yeah, the e-commerce side.
They're combining Tao Bao, Tmall, Elle.me, which is their food delivery, and Fliggy for travel into one big Alibaba China e-commerce group.
It's a huge move, more than just shuffling boxes on an org chart.
Seems like it. The goal is this unified, comprehensive consumption platform. And they're throwing, what, RMB 50 billion specifically at consumption, focusing hard on quick commerce.
And if you connect the dots, this isn't just about reorganizing. It's a massive investment aimed at totally redefining how consumers interact with them, especially through quick commerce.
The quick commerce numbers are pretty eye-popping already.
They really are. Monthly active consumers hit 300 million in August. That's, 200% growth since April? That's incredibly fast.
Peak daily orders hitting 120 million, weekly average 80 million. Daily active riders over 2 million, a threefold increase.
Yeah, the scale-up is happening very, very quickly. It shows huge user uptake for this integrated approach.
So how does this impact the existing platforms, like Tao Bao?
Well, they said quick commerce is already driving 20% growth in Tao Bao's daily active users, the DAUs. And people are buying more often. The average purchase days per user is up significantly.
And the big target. They're projecting quick commerce will add RMB 1 trillion in annualized incremental GMV gross merchandise volume within 3 years.
1 trillion RMB. That's ambitious.
Hugely ambitious. Which brings us back to that crucial question. Profitability.
Yeah.
Quick commerce is notoriously tough on margins.
Absolutely. And management is upfront about it. They said it's not standalone profitable yet. No surprise there.
But they expect to cut the unit economics losses, the loss per order, basically by half in the short term. How?
They're focusing on optimizing the mix of customers and orders, targeting more profitable transactions and making fulfillment much more efficient.
And their long-term goal is industry-leading efficiency. Not just in food, but non-food too, using this lightning warehouse model.
Yeah, they've already got over 50,000 of these warehouses active. This feels different from their past efforts because it's so deeply integrated into Tao Bao.
Leveraging the existing platform, the supply chains.
Exactly. And that massive 88 VIP member base, over 53 million high-spending users now, that's a built-in audience for these new services. That integration might be the key differentiator this time.
Okay, let's look at how these strategies are hitting the segment results then. Cloud Intelligence Group revenue up 26% year over year.
Yeah, strong growth, driven, like we said, by public cloud and that surging AI demand.
And the adjusted EBITDA margin held relatively stable at 8.8%.
Which is pretty decent considering the growth phase. That 26% revenue acceleration is key. It shows strong demand from external customers to automotive, education, healthcare, multimedia. It's broadening out.
And that RMB 38.6 billion in CapEx this quarter just for cloud underlines their commitment.
No doubt. They're spending big to scale big.
Now, the China e-commerce group, this new combined entity, revenue up 10%.
Okay, decent growth.
Customer management revenue, CMR, also up 10%. They said that's mainly from a better take rate.
Which means they're earning a slightly bigger slice of each transaction.
Yeah, partly from that 0.6% software service fee they added last year, and also better monetization using their AI advertising tool, QZT.
Right. But what about the profit for this segment?
That's the catch. Adjusted EBITDA for China e-commerce decreased by 21%.
Ouch. Down 21%.
And management was very clear. Excluding the investments they're pouring into quick commerce, the group's profit would have actually grown year over year.
So that really spells out the trade-off, doesn't it? Sacrificing current e-commerce profit for that future quick commerce growth.
Crystal clear trade-off. Now, international digital commerce, ADC, revenue grew 19%.
Driven by AliExpress Choice and Trendyol, their cross-border stuff mainly.
Well, yeah, solid growth there.
And what's really interesting is that ADC's adjusted EBITDA loss narrowed significantly. It's getting close to break even.
Which suggests those international platforms are scaling efficiently now.
Exactly. It looks like those past investments are starting to pay off, becoming more sustainable. That's a positive sign.
Finally, capital allocation, still buying back shares, $22 billion left on the authorization through March 2027.
So still returning cash to shareholders.
But it's clearly a balancing act, right? Shareholder returns versus these massive growth investments.
It really is. And you have to wonder how sustainable that balance is.
How do they justify it?
Well, management basically says they have sufficient resources. They point to their balance sheet, their cash flow. They believe they can fund both at scale.
So the priority is clear.
Yeah, it seems to be growth and market leadership in AI, cloud, and quick commerce. They seem to believe that holding back now, focusing only on short-term profit, would mean missing out on much bigger long-term prizes.
It's a calculated gamble then, a bet on future dominance.
Absolutely, a very big calculated gamble.
Okay, stepping back from the specific numbers, what's the broader context here? The macro trends, the competition?
Well, like we touched on, cloud demand, especially linked to AI, is strong globally. That's a tailwind.
But in China.
The consumer market there is still pretty value conscious. The overall economy isn't booming, which puts pressure on e-commerce growth generally.
And competition is fierce, right?
Fierce is an understatement. Domestically, you've got Pinduoduo, Douyin. They're really challenging Alibaba in core commerce.
And even in food delivery, it's not just Meituan anymore.
Right, it's shifting to more multi-platform competition. Alibaba frames this as good for the industry, more choice.
But it definitely makes winning harder and puts pressure on their efficiency goals in quick commerce.
No doubt.
Looking ahead, they didn't give specific financial guidance, did they?
No numeric guidance for the next quarter or year. But they heavily emphasized continued CapEx in cloud and AI and these selective investments in core commerce and logistics.
Their long-term vision is huge, though. This AI plus cloud platform plus the comprehensive consumption platform, targeting an RMB 30 trillion addressable market.
30 trillion RMB. It's an astronomical number, reflects the scale of their ambition, but it's also, a very long-term vision.
So for investors watching now, what are the key things to look for? What will move the needle in the near term?
I think near term, it really boils down to proof points.
Yeah.
Can that AI-driven cloud demand truly out-earn the massive spending?
Right. Can they show the ROI on that cloud investment?
Exactly. And can domestic commerce re-accelerate growth without completely tanking margins, especially with all the money going into quick commerce?
Those seem like the two biggest questions.
Yeah, plus watching the unit economics in international commerce, can they get to sustained profitability there? And of course, broader things like policy, the macro environment in China, and how effectively they balance buybacks versus growth spending.
So sentiment really hinges on showing that these big, expensive bets have a clear path to actually making money.
Precisely. It's about execution and proving the strategy works, not just on paper, but in the P&L.
Okay, let's shift to our final segment. This is not financial advice, where we brainstorm some maybe wild, but perhaps plausible trade ideas based on everything we've just discussed.
All right, let's get speculative. Given the scale of these investments and what they're saying they want to achieve, here's one idea.
Lay it on us.
Consider a long position on Alibaba stock, BB. Target maybe significant upside over the next, say, 18 to 24 months.
Okay, long baba. What's the outrageous but plausible angle?
It hinges on them hitting those huge targets faster than anyone expects. Imagine quick commerce, not just hitting that RMB 1 trillion incremental GMV goal, but doing it sooner, and cutting those unit economic losses by half, even faster than their short-term projection.
So execution exceeding expectations on quick commerce.
Right. And couple that with AI-driven cloud revenue accelerating. Not just growing fast, but the pace of growth actually increasing. Maybe that SAP deal really kicks in, other enterprise deals follow, leading the market to suddenly give that cloud business a much higher valuation multiple.
So the bet is that the market's current skepticism about the short-term costs gets overwhelmed by faster than expected long-term gains materializing, especially if the Chinese economy finds its footing.
Exactly. You're betting that these historic opportunities pay off quicker and bigger than the consensus currently believes. Outrageous because of the execution risk, plausible because the targets, if hit, are transformative.
Okay, interesting. Got another one. Maybe something different.
How about a more contrarian, maybe even aggressive play? Consider a selective short position on some of the smaller pure-play food delivery or local service companies in China.
Shorting the competition. Why?
Because Alibaba is committing RMB 50 billion to consumption, aiming for industry-leading efficiency, and showing incredibly rapid user growth in quick commerce. That suggests they might be about to trigger, or at least intensify, a major market consolidation.
So the bet is that Alibaba's sheer firepower crushes smaller players.
Kind of. The outrageous part is betting on Alibaba, which hasn't always been the nimblest player in, say, food delivery specifically, to suddenly become this hyper-aggressive market share grabber using its integrated Tao Bao ecosystem.
And the plausible part.
The plausible argument is that Alibaba's resources, cash, users, existing logistics via Eli.me supply chain synergies could actually create an almost insurmountable competitive advantage this time. They could potentially squeeze the margins and the user acquisition ability of smaller, less well-funded rivals.
So it's a bet that Alibaba's integrated, capital-heavy approach finally overwhelms the more specialized players in that local services space.
Precisely. Betting on consolidation driven by Alibaba's sheer scale and integration. A riskier, more targeted bet than just going long Baba.
Okay, Two very different ways to think about the implications. So wrapping up, we've seen Alibaba making these huge, ambitious pivots. AI and cloud on one hand, a totally revamped consumption platform on the other.
Yeah, it's definitely a story of massive investment today, betting on what they genuinely seem to believe are historic opportunities for tomorrow. It's all about balancing that short-term profit pressure with this very long-term vision.
Indeed. And the key question for investors, as we've said, is can they deliver the proof? Can AI cloud demand really outpace the spending? Can e-commerce grow again without margins collapsing further?
Those are the billion-dollar questions.
Yeah.
It's certainly a dynamic and fascinating period for Alibaba. The next few quarters are going to be absolutely critical viewing.
We hope this deep dive into Alibaba's earnings has given you some valuable insights and things to think about. Definitely keep an eye on how this story unfolds.
And please remember, everything we discussed today is strictly for educational and informational purposes. It is absolutely not financial advice. Always, always do your own research and due diligence.
Thanks for tuning in to Talk Tickers. We'll catch you on the next one.